You've probably seen enough movies to have at least a working understanding of zombies. There's a plague, solar storm, or some other cataclysmic event, and the next thing you know, you're running for your life from the reanimated dead. So, what could we possibly mean when we call a financial institution a zombie bank? Well, if the word zombie refers to something that should be dead but for whatever reason is still up and running around, you might have an idea where this video is going. The phrase zombie banks refers to financial institutions that are insolvent or nearly insolvent but continue to operate with the help of government support, otherwise known as bailouts. If you live in the United States, the concept of a bailout should be very familiar to you. However, the repercussions of such government intervention often go far beyond the claimed misuse of taxpayer funds. By keeping these banks afloat artificially, government officials may be throwing the entire economic ecosystem out of balance. On March 10 of 2023, Americans watched as the biggest failure of a U.S. bank since the global financial crises played out before their eyes. Silicon Valley Bank, a major lender to the tech industry, was succumbing to what might otherwise be considered a traditional bank run. This is when a large number of depositors simultaneously withdraw their funds from a bank due to concerns about its solvency or stability. And SVB's depositors had some very serious concerns, serious enough to put the bank under in less than 72 hours. However, before long, the U.S. government decided to intervene. First, the Federal Deposit Insurance Corporation, or FDIC, took control of SVB, which had taken a multi-billion-dollar loss cashing out government bonds to pay off its depositors. 2 days later, the FDIC shut another lender, Signature Bank, down completely after it experienced a similar run. It's worth noting that both of these banks had massive amounts of uninsured deposits on record. Even so, the effects soon spread to larger banks, including Silvergate Bank and First Republic Bank. Ironically, in order to stop the spread, the U.S. Treasury Secretary Janet Yellen and Jamie Dimon, CEO of J.P. Morgan Chase, decided to inject a combination of public and private cash into the situation. This is standard operating procedure for the United States. Whenever a bank or other big business finds itself at risk of collapse, the government will always step in to provide emergency loans, inject liquidity, or negotiate the merger and acquisition of the organization's assets by a more stable entity. The goal of these interventions is to restore market confidence and, whenever possible, stabilize the stock prices of the affected bank. But like putting a band-aid on a broken dam, it doesn't solve the problem, even if it appears to do so for a little while. You may have heard that the United States promotes a little idea called free market capitalism. In fact, the country is extremely proud of both its capitalist past and present. However, bailing out failing companies, banks or otherwise, is very far removed from what you might call free market principles. In a true free market, failure happens. By letting it happen, the country ensures that only those institutions that avoid risky practices can thrive. That said, there are reasons why the U.S. government and regulators would want to prop these banks up. 2008 was a great example. If you don't remember, that was the year the collapse of Lehman Brothers sent shockwaves through the global finance world. Lehman Brothers had embraced numerous toxic assets, including subprime mortgages, but so had dozens of other major banks. To prevent a collapse of the U.S. financial system, the Federal Reserve and the Treasury Departments implemented various bailout initiatives and measures like TARP, the Troubled Asset Relief Program. While it's true that an injection of liquidity can save a failed bank, it can't save the company from being seen as a failed bank in the eyes of consumers. So while the cash allows the bank to keep on living, so to speak, it will never reach its former strength or reputation again. After all, economics is all about confidence, and a bank nobody has confidence in isn't unlikely to ever be profitable. But then what happens? The government just spent billions to prop the bank up. They're not about to let it limp around for a few months and close. So, in many cases, regulators might end up giving the institution more money just to keep them going a bit longer. This is why the zombie term is so appropriate. Much like The Walking Dead, the banks slowly move from bailout to bailout, contributing nothing and hoping to someday get acquired by a competitor. That way, the board and the investors can cash out their chips and walk away, money in hand. But here's the other problem. Like the zombies from our favorite horror movies and TV shows, zombie banks can actually infect other institutions. For instance, banks often lend to each other through interbank loans. If a zombie bank defaults on its obligations, it can increase consumer concerns about any bank exposed to it. The problem is that banks can't exactly ignore their zombified competitors either, as this will cause credit lines to tighten and strain liquidity in the marketplace. It's also important to remember the confidence factor mentioned a moment ago. When consumers hear about one bank failing, they can sometimes react in ways that aren't exactly rational. So even if a bank has nothing at all to do with the zombified bank, it could still experience a run that puts it at risk of ending up the same way. Certainly, government bailouts will never solve the problem at its root. Before we discuss the root cause of zombie banks, you may wonder how the term was coined. Edward J. Kane, a prominent economist and professor who has made significant contributions to the field of banking and financial regulation, was the first to use the term in 1987 to explain the dangers of tolerating a large number of insolvent savings and loan associations. In his 1992 essay about the savings and loan insurance mess, he discussed the issues surrounding a crisis that had rocked the U.S. economy several years earlier, and essentially predicted the effects these banks and the bailouts that caused them would have on our overall financial system. We mentioned earlier that the main problem with bailouts is that they don't address the root problems that allow zombie banks to keep shuffling through our financial system. Well, that's because there's no single culprit which to place the blame. That said, economists familiar with the zombie bank phenomenon tend to focus on a policy called quantitative easing when attempting to identify the so-called patient zero. Quantitative easing is a monetary policy tool employed by central banks to stimulate the economy when traditional monetary policy measures, like adjusting interest rates, become ineffective. Following the global financial crisis of 2008, several central banks, including the U.S. Federal Reserve, the Bank of England, the European Central Bank, and the Bank of Japan, implemented aggressive quantitative easing measures. As a result, they increased the supply of what's known as cheap money to the financial system. The banks, suddenly flush with cash, get to decide what they want to do with that money. And in the case of Silicon Valley Bank and many others, the decision was to go right back to high-risk investments. Just like the subprime mortgage crisis and the savings and loan crisis before it, some banks simply couldn't resist the temptation to roll the dice on volatile industries, companies, and ideas. Due to the lower interest rates resulting from the 2008 breakdown, small and mid-sized banks also became much less likely to hold cash. Instead, they supported their liquidity through short-term borrowing. And by the time the 2010s arrived, banks of all sizes were growing a bit tired of the regulations imposed on them by the Dodd-Frank Act of 2008. Through a series of acts and bills, Wall Street-friendly politicians began rolling back some of the rules intended to protect consumers and prevent another crisis. This brings us to the present day. However, the bankers eventually paid a heavy price for their reckless disregard for risk management. In case of a rate hike, banks could no longer support themselves through short-term borrowing due to high cost of loans. This wasn't their only nightmare. The rate hike would likely deal a blow to their investments. It's no surprising revelation that their operations wouldn't be sustainable after the Fed raised the interest rates. Before its collapse in March 2023, Silicon Valley Bank had a cash ratio of 6%. Meanwhile, First Republic Bank had a cash ratio of just 2%. Big banks, on the other hand, do their best to maintain a 20% cash ratio. Apparently, managers in mid-sized banks have completely overlooked their risk management protocol and broken their promise to safeguard your wealth. No matter how ideal their mission statements were, their empire was built on sand. When you put it that way, collapse seems like a foregone conclusion. However, these banks have learned that collapse is not the end. Through bailouts, they can continue to embrace their risky investments as they please. They'll either get bailed out again or simply be absorbed into another financial institution. They get to gamble with taxpayer money, and their only punishment for losing is a fresh injection of cash. Unfortunately, this cycle may very well prove impossible to break. As with the zombie outbreaks we see in the movies, zombie banks are only motivated by one thing: to eat. And they have no reason to stop until they've devoured everything. That's the end of this video. I hope you enjoyed it. Feel free to sound off in the comments, and please like if you found this presentation informative. See you next time.